Major funding for these programs is provided by grants from HSH Nordbank and First American Title Insurance Company of New York, Perfect Building Maintenance, Allied Partners, Bank of America, Murray Hill Properties, SJP Properties, Greenberg Traurig LLP. Additional funding is provided by grants from Antares Investment Partners, Arbor Realty Trust, Athena Group, BRT Realty Trust, Burden LLP, C.B. Richard Ellis, City Habitats, City Investment Fund, Cushman & Wakefield, Eastern Consolidated, Essex Capital Partners, Helmsley Spear, James D. Kuhn Real Estate Institute at Syracuse University, Jackson Development Group, Meridian Capital Group, McSam Hotel Group, Newmark Knight Frank, Moynihan Organization, Muss Development, Palin Enterprises, Rosenthal and Rosenthal, Signature Bank, Sidney Fettner Associates, Stonehenge Partners, Studley, Sutphin Properties, the Wickoff Organization, Extreme Construction and Deconstruction.
Hello, my name is Michael Stoll, host of the Stoller Report, Real Estate Trends in the Tri-State region. We're in a tough time today, in the real estate and the general economy, and who really knows what's going on. A lot of real estate in America is controlled by real estate investment trusts, and I'm fortunate today to have three prominent heads of great real estate investment trusts to talk about the market, a little bit about the REIT world, and where they see the market going. My guests today include Mitch Hirsch, President and CEO of Mack Cowley Realty Trust, Ed Glickman, President and COO, Pennsylvania Real Estate Investment Trust, and last but not least, Ken Bernstein, President and CEO of Arcadia Realty Trust. So Mitch, what's really, we were talking part of the show about how's the market, are we in a recession, where are we, and you're like an 800-pound gorilla, all of you are. I mean, you're the seventh largest, Ed, you're the seventh largest
shopping center
shopping center REIT. You're in the office market, what, the
third largest in the United States, as far as I know.
You're okay in size too.
Can't complain.
You can't complain. So what do you see happening in the office market? I mean, what do we see in the real estate market in general happening today?
Well, clearly there are many challenges and some level of uncertainty in the economy today, and it's unclear as to whether we're going to actually be in a recessionary period or not. But from our perspective, we operate in markets that have been relatively stable, that have good core industries. We as a public company, as a REIT, are extremely well capitalized, very low leverage, and so these challenges, in my opinion, offer some new opportunities going forward.
I mean, but you're all three are public companies. I mean, you've been a public company since 1970. Something
1960.
60 was the initial, and you've been a public company in 94, and you've been in 98. I mean, you're all traded on the New York Stock Exchange. You're all established. You're well capitalized companies. But where, with the economy being a little bit, with oil being over $100 a barrel, with everything else, where do you see what's going to happen? I mean, you're in a difficult. I mean, you're financially okay. I mean, you have your lines of credit and everything else. But how do you see this affecting the office markets, the retail market in general?
Well, look, there's no question that there's a dislocation in the capital markets right now, particularly affecting the residential mortgage community, and it extended to CMBS financing and CDOs. And there's a perception issue as well as a reality right now that there are many challenges in the capital markets, and that's also affected the specter of employment. How will it relate to certainly financial service industries and Wall Street employment, and what the impact will be on the greater economy? But the reality is that we are linked, in my opinion, at the hip with the global economy. And it's going to be important for the global economy to recognize the fact that as the American economy continues to be vital, so will their economies. And notwithstanding a weak dollar, which has benefited many of the petrodollar communities and the European communities, I think that we will sustain these challenges. There will be a reordering of the capital markets. Wall Street, unfortunately, will take some significant write-downs, as they have been in the banking industry. It will have some impact on employment, but I think it'll be relatively short-lived. I think that the capital markets will stabilize, that there will be certain levels of investments that have been made that have been over-leveraged, that have overpaid, but it will reorder itself and will provide opportunities for those companies that have professional management and are well capitalized. And I think all three of us share those benefits.
Ed?
I agree with Mitchell. I think that we're going to have a good year because the changes in the capital market are really opportunities for the REITs, given their more conservative capital structure. We've had to sit on the sidelines in terms of acquisitions for the last few years and watch the high leverage players come into the market. But now that the leverage is out of the market, this makes the public company with its more conservative structure a better buyer.
Now, you were saying part of the show that you felt that we are in a recession.
I said prior to the show that I think we're going to go into a slight recession for probably 2 or 3 quarters in 2008. But I'm optimistic because the job numbers are positive, and I think that when the job numbers are positive, the consumer shops, and if the consumer shops, the retail business will stay okay. It's not going to be great, but it'll be okay.
Since the majority of your business, or all of it's retail, I think you have one apartment complex somewhere that I was reading.
The majority of our business is retail. A significant focus is in urban markets with some mixed use, so we have some residential and some office components.
But what do you see? I mean, listening, I mean, I definitely agree, that the amateur player who is in the market is not going to be buying real estate because they're not going to be able to get the leverage. Mitch said prior to the show when we were meeting that, the spreads are much greater, and we were all saying that the spreads are greater on the cost of financing to get to different levels. So where do you see all this?
So let's take a look at each piece of this.
Yeah.
In terms of the fundamentals, the economy and the consumer, I think that a robust consumer who has driven our economy for the past several years is likely to slow down somewhat. Will the consumer slow down so much that we end up in a drawn-out recession? I personally doubt it, but we have positioned our portfolio over the past several years under the assumption that the consumer slows down. And what that means is pulling out of secondary markets. We sold effectively half our portfolio. We took 10 million square feet down to 5 million in order to get out of markets that secondary consumers may not continue to shop at. So that's one piece of it. In terms of the real estate markets, there's been unbelievable volatility, both in terms of all of our stock prices, but then in real estate values in general over the past 3 to 6 months. I think that continues over the next year. And for the reasons that we've talked about before today, I think that is a real opportunity for well-capitalized companies and a really difficult situation for private buyers who are reliant on 90% leverage.
Now, we were, unfortunately, since I wear many hats, and I'm playing my press hat now, unfortunately, a lot of people who are in the press and the media make the world the doomsday affair. I said a number of months ago it was the summer of discontent. It's now the winter of discontent, and it's not. And it's truly a discontent in certain aspects in the capital markets. But when people pick up the Wall Street Journal and see that the price of, and we were bringing it up before, the price of eggs have gone up 35%, milk has gone up 27%, oil, I don't even want to say what effect. Doesn't this have an effect on that consumer who's shopping in retail centers that you own, and the retail centers you own, and in the office buildings, and the people who are working over there when they're spending money to go to lunch or dinner? Doesn't that have a definite effect?
It certainly does. I think you have to look first and foremost to job creation. And the consumer has shown unbelievable resilience up against far more difficult situations, although certainly at $50 a barrel, if you said $100 a barrel, you'd assume that would wipe the consumer out. It has not. Does $100 to $105 wipe it out? I doubt it. So I wouldn't bet against the consumer, but all of these issues add up to cause some level of concern. The bigger issue right now is over the past couple of years, risk was mispriced. People were treating assets of very different risk profiles as the same value, and now they're sorting through that. You're seeing that in the subprime markets. You're going to begin to see it in the commercial mortgage markets, and you're seeing it across the board in all other types of markets. And we're going to go through a period where there's going to be a lot of volatility as people sort through what risks do they have.
You know, fortunately, the Treasury bills are down, and they've stayed stable on the 10-year. Now, the big question a couple of weeks ago when I had one of your other colleagues and we were talking about the Bronx, and I had an owner, a developer, who used to build 3-family homes in the Bronx. And I said, what's happening with the 3-family home business? He said, I'm out of the 3-family homes. And I said, what happened? He said, basically, 7 months ago or a year ago, my purchaser, who would live in one of the apartments, was able to buy this apartment with 3 to 5% down. Now, they need 20% down. You know, there's no more no-income verification loans. So he said, you know, I had to change my market. And, you know, then you have that other person of the consumer in the Pennsylvania market or the New Jersey market or anything else who says, you know, I had a 5-year adjustable rate mortgage, and, you know, it's going to tick up. It's not even the subprime question. It's that 5-year adjustable mortgage, the interest only, and now they can't get an interest only mortgage. So what effect is that going to have just in general on the economy in your market?
Well, first of all, I think New York City, and it might be important to note, is a bit of an anomaly. New York City has benefited from a great deal of the influx of global capital that's had the advantage of a weak dollar. And so global dollars have been able to invest in New York at relatively modest pricing
But
levels.
Mitch Hirsch, a large portion of your portfolio is New Jersey.
Right.
Most of your portfolio is Pennsylvania and the suburbs, okay, in New Jersey. You know, with the exception of your recent urbanization, you know, you're in the suburbs. So that's a different market. I want to get away from Manhattanization of the show.
Well, I think that the markets have been relatively stable, and that was the point that I wanted to make. We've seen a meteoric rise in valuations and rents in Manhattan and maybe a few other 24-hour global cities, but not too many. We've seen much more stability in the markets that surround the New York metropolitan area. And so we haven't seen acceleration in rents. We haven't seen the vast acceleration in asset pricing. And at the same time, we've continued to see good barriers to entry. So there has not been a lot of new supply that's infiltrated our markets. And I think this is a very important point. And so I think that the markets are resilient enough and to be able to transcend a period of cyclicality and a difficult marketplace for a period of time. There's no question there's going to be a difficult economy. There's going to be pressure on the consumer. Companies and corporate leadership are going to think very deliberately about making plans to expand their businesses in an uncertain economy. But I think that we are in a very solid position in most of our markets because of the factors that I've talked about.
Ed's based in Philadelphia. Philadelphia was going through a resurgence. What's happening today in Philadelphia? What's happening with the economy and all this? You know, we're leaving Manhattan-centric, and then we're going to even talk about you because your office is in Westchester.
Right. We have a diversified economy. It's based on education, which is a boom business for the U.S. It's one of the few things that we're the worldwide leader in exporting, and there's 75 colleges within 75 miles of Philly. So that is a forever anchor to the economy. On top of that, we have biomedical research and a number of drug companies. which I think are going to be positive in the next few years. And so we have good economic diversification. And I want to go back to a prior point that you made about how the price structure and commodities are impacting our shopper. In a number of other areas, you talked about food and energy, both of them rising, but a number of the other areas are benefiting from all the productivity that's come about as a result of the new internet technology and just-in-time manufacturing and global sourcing and all kinds of other things that have really led to almost flat prices or deflation in other parts of the economy. So, as well as the fact that housing, as it goes down in price, is a big part of everybody's market basket. And interest rates, mortgage rates, have not really risen that much. And if you look at the subprime market and you think about where that money went, 50% of the subprime loans were actually made for refinancings. So it wasn't only the buyer that was reaching that took a subprime loan. A lot of it was cash out refinancing of existing housing. It was really only in 4 markets in the US that we saw subprime buyers go in because they couldn't otherwise afford to get in the market. And none of those markets are on the East Coast, with the exception of South Florida. But other than that, those were all West Coast markets. And as Mitch said before, our market is fully built. There's lots of anti-sprawl sentiment. It's hard to get new projects developed. The in-place real estate has a lot of inherent value. And that's the mantra of our company. We want to be in fully built markets where we're not competing with the next ring road that always blossoms out when you're in different parts of the country.
Westchester, a place that you know and a place that you have your office today.
Right.
What's going on there? And then I'll get Mitch on this subject of Westchester. In the real estate market, how do you see it?
From a retail perspective, I'll let Mitch talk about office. It's a fabulous high barrier to entry market. We own some existing retail there on up through Connecticut, Greenwich, Connecticut. We have an exciting development in Pelham Manor, which is probably 30 minutes away from here. And if you can find the right locations and get the right approvals, then the tenants will line up to come in, irrespective of the economy, because it's a once every 10-year decision. But there's not that many developments that you can do in Westchester, so you pick and choose, and it's a portion of what we do, and it is where we're located, and we'd be thrilled to do more, but our expectation is that our growth there will be relatively limited compared to what we're able to do in the 5 boroughs of New York City, where the size of the deal and the scope of them can be much more significant, or in other major gateway cities.
Mitch, the office market.
Extremely
Westchester.
diverse, very resilient, many small to medium-sized businesses with ownership that want to be proximate to their office locations and their flex office locations, great transportation infrastructure, a real raison d'etre. And interestingly, rents that are probably the same as they were more than a decade ago, as we've talked about.
2 decades ago.
Or maybe 2 decades ago.
And
And so you've seen a lot of stability, highly barrier constrained, and again, a very resilient economy. Our occupancies in Westchester are among the highest within our entire portfolio, always hovering in the 94+% range.
Prior to the show, we were talking this subject of the urban shopping center, the urbanization. And you've gone, we briefly discussed it when you were on the show a couple of months ago with downtown Brooklyn. What's this urbanization? And I think you, Ed, could also talk about it because you have urbanization, with your center, the Gallery, or is it?
The Gallery.
The Gallery. So,
one interesting data point. In the United States, there's approximately 22 square feet of retail per person. In the 5 boroughs, the number's 6. So just taking that ratio, and in discussions with the tenants that we work with nationally, we realized that if we could secure the right locations and the right development opportunities for the Best Buys of the world, Home Depots, Lowe's, Targets, etc., that their willingness to come in to more interesting projects, hopefully more profitable ones for us, was much stronger in good times. And then if we go into a recession, having owned secondary assets and seeing what happens, our realization also was that even in bad times, those markets tend to outperform, and thus replacing tenants that might go bankrupt or other things is a much easier process. So that was the general evolution. We're fortunate we had fabulous partners in PA Associates who've done a tremendous job of finding now we've got about 2 million square feet under development, probably well over $1 billion of asset value. So it's exciting. We like it.
You in urbanization, or the urban business.
Philadelphia is a great urban city, and over the last 10 years, we've probably had 15,000 new units developed in residential downtown as a result of former Mayor Rendell's plan for a 10-year tax abatement on residential development, which has brought a ton of people into the center of the city. And we purchased an existing mall that was right downtown in 2 major pieces, and it sits on top of all the suburban train lines. So it's a transportation hub and gets a huge amount of traffic during the day. It's called the Gallery at Market East. And we've seen sales in some parts of this mall approaching $500 a foot, which is a lot better than we had originally expected it would do. And as more and more people move into downtown Philadelphia, we now have a new mayor who's coming in a few days, Michael Nutter, and everybody's very optimistic about what he can do for the city as well. So we're looking forward to a continuation of this reurbanization of Philadelphia, which was one of the largest urban cities in the country for many years and lost a lot of its population, but now is benefiting from a resurgence of people moving into downtowns. And this is a worldwide trend. All over the world, people are moving into downtowns. And so we're very optimistic about Philadelphia.
King of Jersey City. I mean, you talk about what's going on in Jersey City on the on the perspective. Do you own any shopping centers in Jersey City?
Not in Jersey City, certainly in Jersey.
And you? Anything close to Jersey City?
We manage a mall in Jersey City, Hudson Mall.
Phenomenal environment. If you look at the wealth of housing that's been created along the waterfront, and the price point of that housing, the condominium type development, which signifies permanence in the community, and compare that or contrast it to, for example, Manhattan. I know that we're not talking about Manhattan, but you're looking at condominiums from $400 to $700 a square foot versus $2,000 and up in Manhattan, or who knows what the number is. So you have a good residential community to support a workforce, great transportation infrastructure, and state-of-the-art office properties that many of which have been recently constructed. So they have the latest in technology, large floor plates, great place to do business.
I wasn't going to bring it up, but I am going to bring it up. The REITs, it's like in the Bible. They said there are 7 good years and then there's 1 lean year. Last year was a lean year, a very lean year. It started out okay, then it went bad, then it got better, and then it ended up down 17% for your industry, I think. Where do you see in 2008, and nobody has a crystal ball, because the crystal ball would be wonderful, and I'm not Kreskin over here, I don't do that. Where do you see the REIT pricings for 2008, and do you see any more of these equity office, Artstone, these type of deals taking place?
In terms of the privatizations, until the debt markets reload, it's unlikely that you'll see significant large cap privatizations. There's just not the debt available. But more importantly, and I'm not going to predict where stock prices go, except that there has been a repricing because of the reasons we were talking about before, and risk has been repriced. REITs are so much better capitalized than they were during any previous correction. They are so much better capitalized than most of their private counterparts that this will be a net benefit long term. I have no idea what short-term traders should do, when the low will be there, but I can tell you from our company's perspective, our debt's at an all-time low, our lines available are all-time high. We just raised our latest fund.
But you know what? I think here's an interesting subject, and since many people who watch my show are the consumer, if I'm a consumer, and I'm more interested, I'm not really talking about if the prices went down 17%. I'm interested that you give away 90% of your earnings each year. Isn't a REIT investment a great investment for a consumer?
Absolutely, I think so. You look at the balance sheets, as Ken was alluding to in our companies, they're very strong. At these stock prices, we're paying out very high dividend levels. Some cases 7 or even higher percent, 10% in certain cases. And so I think that it's in large measure a great safe investment.
Looking at this, everybody always wants, the first thing that they want to own is their own home. And then they want to have a piece of the rock. Right. And the way that you can have a piece of the rock is by owning shopping centers over here, office buildings over here, shopping centers and urban opportunities, and also getting a dividend. I mean, this is something that, the reason I brought you here is I wanted to talk your perspective, but I also wanted to bring to my audience the value of investing in a REIT, in a good REIT stock. I mean, because they haven't been really, the bad ones are out of business.
It's growth. It's a combination of growth and income, and our stock now is paying about 7.5%, and it's down at least 20% or as much as 40% from where it was at its heights last year. So in essence, if you look at our net asset value, the value of our properties as they would be priced in the marketplace today, you're buying that value at a 40% discount, and you're holding that value and earning 7.5%. So it's an ideal time to buy REITs today. When you think of how much money flew into the market when REITs were priced at yields below the 10-year Treasury, and now we have funds flow out of the market when REITs are priced at 200 basis points above the 10-year Treasury, it makes absolutely no sense. Now is when the money should be coming in.
I don't want to be biased, but if I was an investor, would you say a good mixture, because I have to make sure, would be a mixture of office, retail, and perhaps these healthcare REITs, or the industrial REITs? I mean,
well, I personally think that with the liquidity, and that's an important fact, that you have liquidity. You can go in and out of the market as a consumer, as an individual, to buy a number of different sectors. You can buy industrial properties, apartment REITs, as well as those represented here today. And it gives you the ability to move in and out of the market, which is a phenomenal advantage.
And individuals should really consider putting it in their tax-exempt 401ks, IRAs, because then the appreciation is that much more attractive.
Okay. I would like to thank the three of you who've given me and my viewers a good perspective on the economy, the marketplace, and you never realized that I was going to be giving REITs a sales pitch at the end. I'd like to thank Mitch Hirsch,
Thank you
Ed Glickman, who came from Philadelphia, Mitch, who came from New Jersey, again, everyone, and Ken Bernstein, who came from Westchester. See you next week.
Major funding for these programs is provided by grants from HSH Nordbank and First American Title Insurance Company of New York, Perfect Building Maintenance, Allied Partners, Bank of America, Murray Hill Properties, SJP Properties, Greenberg Traurig LLP. Additional funding is provided by grants from Antares Investment Partners, Arbor Realty Trust, Athena Group, BRT Realty Trust, Burden LLP, C.B. Richard Ellis, City Habitats, City Investment Fund, Cushman & Wakefield, Eastern Consolidated, Essex Capital Partners, Helmsley Spear, James D. Kuhn Real Estate Institute at Syracuse University, Jackson Development Group, Meridian Capital Group, McSam Hotel Group, Newmark Knight Frank, Moynihan Organization, Muss Development, Palin Enterprises, Rosenthal and Rosenthal, Signature Bank, Sidney Fettner Associates, Stonehenge Partners, Studley, Sutphin Properties, the Wyckoff Organization, Extreme Construction and Deconstruction.